12 hours changed the conversation around silver in a way few traders expected. Roughly $297 billion in market value appeared almost overnight, pushing the metal into headlines while most analysts were distracted by stock movements. What unfolded wasn't simply a routine surge. It was a sudden and highly unusual shift centered around activity emerging from Asian markets, particularly Shanghai. Traders began noticing signals that didn't fit traditional volatility patterns. Delivery allocations vanished, trading accounts were suspended in rapid succession, and an enormous price gap formed between Eastern and Western exchanges. Meanwhile, silver's price rebounded sharply despite recent heavy losses. For experienced market watchers, these weren't isolated events. They were clues pointing toward deeper structural pressure. The key question for investors and business leaders wasn't whether prices had moved quickly. The real concern was whether the underlying supply of physical metal was being stretched beyond what existing financial systems could comfortably handle. As markets opened in New York following the overnight surge, traders stared at screens trying to make sense of the sudden price shift. A 7% move in silver wasn't unheard of, but the speed and size of capital inflow made this event different. Billions poured into the market in less than half a day, creating a surge rarely witnessed in modern commodity trading. Analysts began pulling historical comparisons, looking back to previous rallies like the dramatic rise in 2011 or the pandemic-driven volatility of 2020. Yet even those intense periods didn't quite match the pace of this new movement. Institutional desks scrambled to understand what had changed so quickly. Some suspected coordinated buying, while others wondered whether industrial demand had quietly spiked. The fact that the surge appeared to originate heavily from Eastern markets only deepened the mystery and sparked debates across trading floors worldwide. Just days before the massive rally, silver had experienced a steep decline that shook leveraged traders across global exchanges. Prices had dropped sharply, triggering margin calls that forced many participants to liquidate positions. The resulting sell-off resembled a classic market flush, a sudden collapse designed to remove weak hands and excessive leverage. Many believed the downturn signaled the end of momentum. However, what followed caught analysts off guard. Instead of entering a prolonged consolidation phase, silver staged an aggressive recovery, reclaiming a large portion of its losses within a week. Historically, such rebounds take months to develop, not days. This rapid recovery prompted institutional investors to examine trade flows more closely. They wanted to know who was accumulating during the chaos and why buying pressure seemed to concentrate in specific regions rather than across global markets equally. A closer look at regional pricing began to reveal the real story behind the surge. Western markets showed silver trading within expected ranges, with spot prices slightly above futures contracts, a normal relationship reflecting storage and carrying costs. But when analysts examined Shanghai pricing, the numbers looked dramatically different. Spot silver in Eastern markets traded significantly higher than in Western exchanges, while futures prices displayed even more extreme premiums. Such discrepancies immediately drew the attention of arbitrage traders who specialize in exploiting price differences between regions. Normally, price gaps close quickly due to shipping and logistics. Yet, transportation costs and insurance rates had remained stable, meaning something else was driving the divergence. The only logical explanation was regional scarcity. Buyers in Eastern markets were willing to pay considerably more to secure physical silver, suggesting supply constraints were emerging where demand was strongest. Experienced commodity analysts began comparing the widening price gap to inventory data from major storage facilities. Western warehouses showed only modest drawdowns, nothing historically alarming. However, vaults connected to Asian exchanges were experiencing unusually high withdrawal rates. The pattern suggested that buyers in Eastern markets weren't simply trading paper contracts, they were actively removing physical metal from storage. This behavior indicated a shift toward long-term accumulation rather than short-term speculation. Meanwhile, Western markets continued to rely heavily on derivatives and synthetic exposure, creating a growing disconnect between financial claims and tangible supply. As the divergence intensified, analysts warned that such imbalances rarely persist without consequences. When physical demand accelerates while paper trading dominates elsewhere, pricing distortions can widen dramatically, setting the stage for volatility that eventually forces markets to reconcile financial expectations with real-world inventory levels. While price discrepancies and capital inflows were already raising eyebrows, regulatory actions added another layer of concern. Exchanges rarely intervene aggressively unless they believe market stability is at risk. Yet within a single week, multiple trading accounts were suspended on one of Asia's largest futures platforms. The number of suspensions far exceeded normal levels, suggesting unusual activity was occurring during the surge. Market observers speculated about potential manipulation, excessive speculation, or attempts to exploit delivery mechanisms. Others believed exchanges were simply trying to prevent settlement failures amid rapidly tightening physical supply. Regardless of the specific reason, the timing aligned perfectly with the fastest price movements, reinforcing the perception that something deeper was unfolding behind the scenes. For experienced traders who had witnessed past commodity squeezes, regulatory intervention often signaled structural stress rather than ordinary market excitement. A regulatory announcement released quietly in late February intensified speculation further. Hidden within technical language was a statement that certain participants would receive zero delivery allocations for upcoming silver contracts. This wasn't merely a reduction or temporary limit. It meant some traders could not convert paper contracts into physical metal regardless of contract terms. Futures markets rely on the assumption that physical delivery remains possible, even if most participants settle financially. That underlying promise anchors pricing and ensures confidence in the system. Removing delivery options undermines that foundation and signals abnormal conditions. Analysts who read the notice carefully realize the implications were profound. If exchanges restrict delivery, it suggests physical supply is insufficient to meet contractual demand, forcing regulators to manage expectations rather than allow markets to resolve shortages through price discovery alone. Understanding the significance of delivery restrictions requires grasping how futures markets operate. Each contract represents an agreement for future physical transfer, even though most traders close positions before expiration. The possibility of delivery ensures that prices reflect actual supply conditions. Without that mechanism, contracts risk becoming detached from reality. When exchanges intervene and limit deliveries, they essentially acknowledge stress within the underlying market. Some analysts compared the situation to past crises where exchanges altered rules to prevent cascading failures. While such actions can stabilize markets temporarily, they also highlight underlying imbalances that remain unresolved. Traders began questioning whether the volume of paper contracts had grown far beyond the available inventory, creating a fragile structure dependent on confidence rather than tangible resources. If too many participants demanded physical settlement simultaneously, the system could face significant strain. Historical parallels quickly surfaced in market discussions. Observers referenced episodes where exchanges intervened during extreme volatility, including the well-known nickel crisis that forced trading suspensions and controversial rule changes. In those cases, authorities argued intervention preserved market integrity, yet critics claimed it exposed weaknesses in the relationship between paper trading and physical supply. The silver situation appeared less dramatic, but shared similar characteristics: rapidly rising prices, widening premiums, and regulatory measures aimed at controlling settlement risk. Many analysts concluded that the volume of financial contracts tied to silver had expanded faster than physical production and storage capacity. Instead of allowing prices to rise freely to rebalance supply and demand, exchanges seemed to be rationing access through administrative decisions. Such measures often stabilize markets short-term while signaling deeper structural vulnerabilities. Account suspensions during the surge raised additional questions about who was participating in the buying frenzy. Official explanations cited trading violations, but the timing and concentration of suspensions sparked curiosity among market observers. Some suspended accounts reportedly belonged to companies with legitimate industrial hedging needs rather than speculative traders. Manufacturers reliant on silver for electronics, solar panels, and specialized components appeared among those affected. If true, this suggested that companies seeking physical supply were encountering obstacles precisely when demand intensified. For industrial users, access to metal is not optional. It determines production continuity. Restrictions on hedging or delivery channels could push buyers toward alternative procurement methods, including private deals outside regulated exchanges. Such shifts reduce transparency and complicate price discovery, potentially amplifying volatility and widening premiums as buyers compete for guaranteed access to scarce resources. As official exchanges tightened rules, private transactions began to grow. Companies unable to secure deliveries through standard channels turned to direct agreements with miners, wholesalers, and over-the-counter brokers. These deals often carried significant premiums above official futures prices because buyers prioritized certainty over cost. Logistics professionals reported clients willing to pay double-digit percentage markups simply to guarantee delivery timelines. Such behavior indicates stress within supply chains, as firms fear production disruptions more than price fluctuations. When procurement moves away from transparent exchanges into private negotiations, market visibility decreases, and price signals become harder to interpret. Analysts warned that hidden premiums can mask the true cost of scarcity until shortages become impossible to ignore. By the time public prices reflect underlying realities, companies and investors may already face significant financial consequences. Reports from storage facilities worldwide reinforced concerns about tightening physical supply. Warehouse managers in major European ports described declining inventories and increasing requests they struggled to fulfill. Long-term clients accustomed to reliable deliveries encountered unexpected delays and reduced allocations. Similar patterns emerged in North American and Asian vaults, where withdrawals accelerated while replenishment lagged behind. These developments suggested that physical silver was leaving storage faster than it was being replaced. Meanwhile, trading volumes in derivatives markets continued to expand, increasing the number of claims on limited inventory. The growing gap between paper exposure and physical availability raised fears of a potential squeeze if more participants demanded actual metal simultaneously. For seasoned market veterans, such imbalances have historically preceded significant price volatility and structural adjustments in commodity markets. One of the most striking aspects of the silver market is the ratio between physical supply and paper trading volume. Analysts estimate that for every ounce of physical silver stored in warehouses, hundreds of ounces are represented through derivatives, exchange-traded funds, and other financial instruments. This structure functions smoothly as long as most participants settle financially rather than requesting delivery. However, when industrial users and investors begin demanding physical possession simultaneously, the system faces mathematical limits. The sudden surge in Eastern demand raised concerns that delivery requests could increase beyond manageable levels. If that occurs, exchanges must either source additional metal quickly or impose restrictions to prevent settlement failures. The delicate balance between financial liquidity and physical scarcity becomes increasingly difficult to maintain as more participants question whether available supply truly matches the scale of outstanding claims. Open interest data from major futures exchanges illustrates the potential mismatch between contracts and inventory. Registered silver available for delivery represents only a fraction of total claims represented through outstanding contracts. While this imbalance is typical in commodity markets, it becomes problematic when physical demand rises unexpectedly. Eastern exchanges, which often require actual delivery rather than cash settlement, exert additional pressure on global supply chains. Buyers in these markets expect tangible metal rather than financial exposure. As premiums widen in regions requiring physical settlement, traders recognize that paper contracts alone cannot resolve supply shortages. This dynamic contributes to persistent price gaps between regions and encourages arbitrage opportunities that further strain inventory flows. Analysts warn that if delivery requirements expand while production remains stable, markets may experience prolonged volatility as participants compete for finite resources. Industrial users began experiencing the effects of tightening supply firsthand. Solar panel manufacturers, electronics firms, and medical equipment producers reported longer delivery timelines and increased procurement costs. Some companies faced production delays due to limited access to raw materials, forcing them to renegotiate contracts or adjust manufacturing schedules. For industries reliant on silver's conductive and antimicrobial properties, substitution options remain limited. Rising premiums therefore translate directly into higher operating expenses and potential revenue disruptions. Executives accustomed to predictable supply chains found themselves navigating unfamiliar uncertainty. The ripple effects extended beyond manufacturing into energy policy, technology development, and defense procurement. When a critical input becomes scarce, strategic planning shifts from growth optimization to risk management. These early signs of industrial strain underscored that the silver surge wasn't merely a speculative financial event, but a development with tangible economic implications. Interestingly, global mining output had not declined dramatically during this period. Major producing nations continued operating near historical capacity, suggesting that supply shortages were not caused solely by reduced production. Instead, analysts pointed to shifts in demand patterns and inventory management. Industrial usage had grown steadily, particularly in renewable energy and electronics sectors, while investors and sovereign entities increasingly sought physical commodities as long-term stores of value. When accumulation accelerates faster than production expansion, available market supply tightens even without mining disruptions. This dynamic explains how scarcity can emerge despite stable output levels. As more buyers move toward long-term holding strategies rather than active trading, fewer ounces remain available for commercial circulation, intensifying competition among those needing immediate. Central banks and sovereign wealth funds have quietly adjusted reserve strategies in recent years, favoring tangible assets alongside traditional financial instruments. While gold receives most attention, other strategic metals have begun attracting institutional interest. Diversification away from government bonds into physical resources reflects broader concerns about currency stability and geopolitical uncertainty. When large institutions accumulate commodities for long-term reserves, those holdings rarely re-enter the market quickly. This behavior reduces available supply for industrial and retail buyers. Analysts observed patterns consistent with sovereign accumulation, contributing to tighter silver markets. Although official announcements remain limited, shifts in reserve allocation can significantly influence commodity flows, especially when global production grows slowly compared to expanding financial demand. Market participants often note philosophical differences between investment cultures in different regions. Some investors prioritize short-term financial gains through active trading, while others focus on generational wealth preservation through physical asset accumulation. When long-term holders remove commodities from circulation, they reduce liquidity and amplify price sensitivity to new demand. Traders in physical arbitrage highlight how divergent strategies between Eastern and Western markets contribute to persistent pricing differences. While derivatives dominate Western trading, Eastern buyers frequently emphasize tangible ownership. As these approaches collide within global markets, the resulting tension manifests through premiums, delivery restrictions, and logistical challenges. Over time, sustained accumulation by long-term holders can reshape market structure by shifting the balance from speculative liquidity toward physical scarcity. Even businesses seemingly unrelated to commodities began paying closer attention to the evolving silver market. Executives in technology and service sectors realized that disruptions in raw material supply chains eventually cascade through manufacturing and infrastructure systems. Data centers, electronics, and renewable energy technologies all rely on metals like silver and copper. When supply becomes constrained, hardware costs rise, affecting everything from cloud services to consumer devices. Financial officers started analyzing potential exposure to commodity volatility, recognizing that price spikes could indirectly impact operating margins and capital expenditures. The growing awareness highlighted how interconnected modern economies have become, where disruptions in one sector quickly ripple across multiple industries. Business leaders increasingly recognized that the silver situation represented more than a single commodity anomaly. It illustrated broader risks associated with complex financial systems becoming detached from physical realities. Paper markets allow enormous liquidity and flexibility, but they rely on underlying resources to maintain credibility. When confidence in delivery mechanisms weakens, volatility can spread beyond commodities into currencies, credit markets, and equity valuations. Executives began considering whether similar dynamics might emerge in other critical inputs, prompting renewed focus on supply chain resilience and inventory management. Risk assessments expanded beyond traditional financial metrics to include logistical vulnerabilities and geopolitical considerations affecting resource availability. Historical precedents reinforced concerns about the potential consequences of prolonged disconnects between financial claims and tangible assets. Examples from monetary history show how shifts in physical supply availability can trigger systemic changes in currency regimes and global trade relationships. Episodes involving precious metals, energy resources, and credit instruments demonstrate that markets ultimately reconcile paper valuations with real-world constraints. When that adjustment occurs abruptly, price swings can be severe and widespread. Observers noted that silver's current behavior resembled early warning signals seen before past financial disruptions, encouraging investors to monitor developments closely rather than dismiss them as temporary anomalies. Supply chain analysts also identified similar patterns emerging in other industrial metals. Copper premiums in certain regions began rising, nickel inventories reached historically low levels, and lithium producers secured long-term contracts at prices significantly above spot markets. These developments suggested broader structural pressure within global commodity systems rather than an isolated silver event. Since many modern technologies rely on multiple specialized metals, shortages in one area often signal vulnerabilities elsewhere. Companies operating in manufacturing, energy, and technology sectors started reevaluating procurement strategies, seeking diversified suppliers and longer-term agreements to mitigate potential disruptions. Rising commodity volatility has implications for inflation, credit conditions, and corporate planning. When input costs increase unpredictably, businesses may pass expenses to consumers or reduce investment in expansion projects. Banks and lenders monitor commodity trends because sudden price spikes can affect borrower solvency, particularly in industries with thin profit margins. As uncertainty grows, financing conditions may tighten, influencing everything from startup funding to large-scale infrastructure projects. The interconnected nature of commodity markets and financial systems means that events initially confined to metals trading can gradually influence broader economic indicators. For investors, the evolving silver situation raised questions about portfolio diversification and risk management. Some viewed physical commodities as hedges against currency depreciation and geopolitical instability, while others focused on trading opportunities arising from regional price discrepancies. However, professionals cautioned that volatile markets require disciplined strategies and thorough research. Sudden surges driven by structural shifts differ from speculative bubbles, and understanding underlying supply dynamics becomes crucial when evaluating potential investments. The challenge lies in distinguishing genuine scarcity from temporary disruptions caused by logistics or regulatory changes. Corporate leaders began exploring contingency plans to address potential supply disruptions. Strategies included increasing safety stock levels, negotiating priority delivery agreements, and investing in recycling technologies to recover valuable metals from existing products. Companies also strengthened relationships with multiple suppliers to reduce reliance on single regions. These measures reflect a broader shift toward resilience in a world where supply chains face geopolitical, environmental, and economic pressures simultaneously. While such adjustments can increase operational costs in the short term, they may prevent larger disruptions if market instability intensifies. Financial markets thrive on confidence that contracts will be honored and delivery mechanisms will function reliably. When exchanges impose restrictions or suspend accounts, participants question whether existing frameworks can handle extreme demand scenarios. Even if such measures stabilize markets temporarily, they can erode trust if perceived as evidence of deeper structural weaknesses. Transparency and clear communication from regulators become essential to maintain credibility. Investors watch closely for signs that interventions are temporary safeguards, rather than indications of systemic breakdown. As the silver story unfolded, analysts emphasized the importance of distinguishing between speculation and structural change. Not every price spike signals long-term scarcity, but certain indicators, persistent premiums, delivery limitations, and industrial supply disruptions suggest deeper shifts. Monitoring inventory trends, production data, and regional demand patterns helps determine whether markets face temporary imbalances or evolving supply constraints. Educated investors and business leaders rely on multiple data sources rather than headlines alone to interpret complex developments. The psychological aspect of markets also plays a role during rapid commodity movements. Fear of missing out can drive speculative buying, while fear of shortages encourages hoarding behavior among industrial users. Both reactions amplify volatility and complicate price discovery. Experienced traders recognize that narratives can spread quickly, influencing investor sentiment even before fundamental data confirms changes. Maintaining a disciplined analytical approach helps avoid emotional decision-making during periods of intense market attention. Looking ahead, the future trajectory of silver depends on several factors: industrial demand growth, mining output, central bank policies, and geopolitical developments affecting trade flows. If physical accumulation continues while production remains stable, premiums may persist or expand. Conversely, increased recycling, substitution technologies, or new mining projects could alleviate supply pressure over time. Markets constantly adapt, and structural shifts often unfold gradually despite sudden price movements that capture headlines. Ultimately, the recent surge in silver highlighted how quickly commodity markets can reveal underlying tensions within global economic systems. Whether viewed as a warning signal or a temporary anomaly, the event encouraged businesses and investors to reassess assumptions about supply reliability and financial stability. In an interconnected world, disruptions in one market rarely remain isolated. Understanding the relationship between paper trading and physical resources becomes increasingly important as economies depend on specialized materials for technological advancement and energy transition. Those who monitor these signals proactively may better navigate future uncertainty, while those who ignore early warnings risk being caught off guard when market realities assert themselves more forcefully.